Welcome to the More Than More podcast, where we discuss building meaningful, impactful businesses, careers, and lives through real estate. How you doing, sir?
I'm good. It's good to be here. Like I said, it's been a while.
Other than the fact that it's white and Christmassy outside, finally. I thought we were going to avoid winter this year.
Yeah, I was actually okay avoiding winter, but...
Me too. Do you think this will have any impact on sales in the next week or two? Because I feel like it's been spring all January.
I don't think this is going to affect it. I think there's too many conversations happening. And again, nice job, Angela, sales contest. I think people are talking, and that's exactly what we need. And I don't think people want to stall.
Well, it's been a while.
Yeah.
I really don't recall. Maybe October, maybe November since we talked market. I feel like everything's been in a holding pattern. We've been waiting for elections. We've been getting to inaugurations. We've been watching the world get a little crazy out there with, we were just talking earlier about CFPB and government departments being cut left, right, and center. But in the midst of all that noise, I guess the real estate market's just been sort of steadily chugging along.
Yeah.
And earlier on, you were mentioning just recent announcements and changes. It sounds like you think that some of that's going to have an impact on changing trajectory here.
I do. And, you know, it is interesting because we talked for the last 3 or 4 months. Should we be doing some type of market update? And like, no, I don't know what we'd talk about, right? Like, I mean, things had been stable and been good, especially within our walls, but nothing that I'm like, this is something we should talk about. There's enough going on now that I think it's worth talking about. And I think this is a really great time to be here just based on what's going on nationally in Iowa and then just kind of what looking ahead could be. But things are, like you said before, they're in flux a little bit. And so seeing what that looks like will be interesting.
Part of what I'm interested in doing is I've prepped some national stuff here, and I'm not going to share a lot of these slides or get into the data much. I'm more interested in what I'm seeing nationally, and I know you've looked at a lot of this as well. And then I'm curious to see, because you've got a new statewide system. We'll probably share more details about that later. And just understanding how, at the national level, what's the narrative, where are we headed, and it's a little bit of speculation at this point.
Right.
Is the statewide data looking the same, and then how does that, I guess, hit the road practically for us? One of the things that's been rolling around my head actually in preparation for this, I was just thinking about this whole, how's the market? And I feel like when we ask that question, there's a degree to which that's just language now. And I want to just take a second because I was thinking about, well, what do we mean?
Yeah.
And I think what we mean by how's the market is, I think it's worth actually thinking about the word market. What's a market? A market is a place. In Africa, we're at the care points. There's physical markets. And the market is the place where all the buyers show up because all the sellers show up on the same day of the week and they engage in trade. And on any given week in those marketplaces, there might be an excess of something or a deficit of it. There might be far too many buyers or far too few. And the market is just the gathering place where buyers and sellers get together in a certain environment, which determines the rate of sale, the price. And that's really what we're talking about here.
Right.
Maybe I need to get
Not a whole lot different yet. Need to get there. It's
a much more complex version of the same thing. So I'm going to take a stab at 3 elevator speeches, and I want to hear how you feel about some of these in terms of what you're seeing in the marketplace. We've been working with our agents to try to get better at their elevator speeches and thinking about how to respond. And one of the things we've shared is how's the market. The way to answer that question has a lot to do with who we're talking to, who's asking the question. So I'm going to start with agents. I wrote some stuff down here. If an agent's asking me how's the market, I'm thinking that right now it's a little dynamic out there. And what I mean by that is I think it depends on what geography you're talking about. It depends. So like nationally, some states right now are seeing price reductions. We'll get into that. Others, we're still seeing stuff hold the line really, really strong. But there's change in the air because I think some of our expectations that we've had on where the market was going to go maybe are shifting, and interest rates would be a good example. We're going to get into that. I wrote that it's better than yesterday. The market's we're not dealing with 8% interest rates, and we're not dealing with an uphill battle. We know we're maybe on the back end of this, but also we don't see relief on interest rates anytime soon based upon what we've heard. So give me your quick take. If an agent's asking you, how's the real estate market right now, what's your 30 seconds on that?
And it is. It's better than it was. It's not great. We know we're still down inventory, but comparatively, inventory looks great. And so what do our agents really care about is, are their houses to sell?
Yep.
And are interest rates affordable? Are buyers going to be interested at the current rate that we're in? And we can't control rates, and technically we can't control inventory. But if we're looking at what is going to get the market going, we've got the product. And especially when we see market by market, inventory is increasing.
Okay. So the demand side rates, there's really no stimulus going on from what we can tell, but we do at least have more to buy, which is probably good for affordability, which leads me to the next one. If a buyer's asking the question, how's the market right now? What I wrote here is that we're seeing maybe the light at the end of the tunnel, the beginning of better affordability. And I think what I mean by that is prices didn't skyrocket by another 20% last year. They at least held the line. And interest rates at least aren't notably going up anymore. They seem to be hovering just around that under 7%. We'll talk about that in a minute. And most importantly for a buyer, it seems like there's more options, which is what you just touched on. What would you add or subtract from that?
No, I think that buyers in general have started to accept where interest rates are. Yep. And so if you can accept the fact that for 3 years now, we've been between 6 and 7. Right now, we're in the middle of that. It could fluctuate up and down, but we're historically right where we normally are.
For 30, 40 years.
Yeah, for decades. Buyers are accepting that now, and so it's not the interest rates that are holding it off. Price acceleration isn't where it was, so we're not appreciating like we were. So for buyers right now, with inventory increases, this is your time.
It's not more affordable, but it is what it is.
Yeah.
And the psychology of buyers, they've moved on from the hope of 3% or it going back down. Yep. And I think we're seeing that in the sentiment. I've got some fun data on that to come.
Yeah.
Sellers. I think this one's notable right now. I'm talking to any seller right now. I wrote here that the market is pretty competitive on the seller side. You have to be well-positioned and well-prepared. And I think you have to, at this point, price ahead of the market. Yeah. Those are the points I had there. What would you add? How's the market?
That's pricing matters probably more than anything else right now, because of the influx in inventory, statewide, market-wide. Pick your location. The increase in inventory, your pricing is going to matter. Not today. Your pricing is going to matter in a few weeks, because as we see a continued increase in inventory, you're going to have to be more competitive. And so I think pricing is the big conversation with sellers right now.
Pricing and preparedness, I've heard our agents talk about. Your house has got to be spick and span and ready to go, because buyers are finicky, maybe is the right word,
again, it's not 21, it's not 22, where you literally, I mean, you got as the seller all the control. Hey, you know what? You're going to have 1 hour, bring all the buyers through, and that's all we're showing. We now see sellers having to give a little, and we'll talk about it in a bit, but I mean, we're at about a 4-month supply of inventory in the state of Iowa. It's been a long time since we were on the other side of 3. Like, we're approaching what we've always said was a stable market at 6. Sellers are losing that extreme power they had. And so the conversation with sellers is just, it's not what it was, but it's still good.
Okay, really good. And I want to remind everyone and encourage everyone to keep working on your capacity to have 30-second, well locked and loaded responses to how the market is that open doors for further conversation.
Yes.
But ultimately point people in I guess the word I would use is be an expert advisor, but also lead with insight. Provide insight and guidance in that 30 seconds. And I think it's something we have to keep practicing.
Well, no, and you're right on, because I've seen enough agents that their canned response is market's great and now's the time to buy. And it sure is, but that doesn't provide any insight. Right, we need to be able to explain, and we talk about like stats need to be able to tell the story. And if we can give that story, now our clients, it doesn't matter who's asking, we might address it differently, but those numbers are going to matter.
Well, and now's the time to buy. True or not true is maybe not the best response, simply because your audience is going to look at that and go, well, hold on. Like, number one.
Of course you want me to.
Yeah, that sounds self-serving, I guess.
Yep.
Okay, I got 4 main topics I want to cover in terms of just the categories. They're the same ones I think we always cover: inventory, rates, sales, which is ultimately what should matter to real estate agents, and then price, which I think is more what all of our sellers and buyers are concerned about and interested about. So let's start with inventory. I'm going to try and shoot you a national thesis here.
Yeah.
And then maybe give me insights on what you're seeing or understanding or thinking about in the, I guess, statewide Iowa market.
Yeah.
So here's what I know, at least here's what I think I know about inventory nationally. So it seems, like you said, that we're beginning to return to what we could call a pre-pandemic inventory level.
Close, yeah.
And we're not quite there yet. So right now we're, I believe, nationally 27, almost 28% up in inventory. This is single family data from where we were 1 year ago.
Right.
And I know that that's up another 20, 30% from where that was a year before that. So that's a notable increase in inventory. And I think that's being fed by some freeing up of sellers that have been rate locked, though not much. Most of them are also still a little hesitant. Yep. But that 27% up still puts us at about 17% below what I believe that's February of 2018. So if we go from now to 2018, we're still 17% lower than we were then, even though we're 27% up and another 20% up. So we've been creeping upwards notably. We're not yet to pre-pandemic levels. And I think what's worth noting is that pre-pandemic levels were 30 to 40% below.
Right. I was just going to say,
inventory levels back in 15, 16, 17. Yep. And so inventory is clearly rising. The projections, as I saw them from Altos and Realtor.com, and this was in the most recent KCM, Realtor.com is projecting an 11.7% further increase in inventory throughout the course of 25. Altos is projecting about 15% increase. So with all that said, they would be suggesting that even at the current rate of sale, with the projections of 5 million sales this year, that by the end of this year, we are close to pre-pandemic inventory levels again, which means more availability. It means more pressure on sellers to price effectively and competitively. And then there's a few other things that I saw here recently from Altos worth noting. There is some slowing, at least relative to even that data, of new sellers coming to market. And some of that slowing, they were anticipating more sellers wanting to list their properties. The slowing that they're seeing, I guess the speculation would be, all this news that we've got about rates that we're going to get into, some people are going, I don't know, we're not getting the prices that we were thinking we were going to get, because that was the other one. 40% of listings right now are taking price reductions nationally. And so given that what we thought our home was worth, it doesn't look like we're going to be able to realize that
because we're competing.
Market. And so I guess we're just going to sit tight. If not for the year, at least right now, it seems like there's a slight slowdown in new listings. So inventory is not climbing as much as anticipated. Maybe that changes in the spring.
Well, and had, right? So if we look at, and again, we're in the middle of February, but if we look through January, year over year, we were seeing nationwide 10% increase, 10% increase, 10% increase until last week where we saw it zero out. And so I think that's what's really interesting is we had this huge influx of listing inventory comparative to previous years. And now we look at it and it zeroed last week. And that's where it's going to be interesting to see what happens.
And your assessment of that is because? It zeroed because?
I think it zeroed because of such a huge increase in inventory that now sellers are looking at rates aren't coming down like maybe we thought. And comparatively, I am competing with more properties than I thought I was going to have to compete with because of these increases week over week. So it wasn't just a month over month increase. We're seeing substantially more listings per week in almost all of our marketplaces. And so that's where I think sellers are pausing and saying, wait, am I getting into the point where I'm competing with too many other people?
And when you say that, you're referencing state data?
State data, but also Altos. So I'm referencing national data when it comes to that 10% through the week. So, and again, not month, but
so
week over week.
I've got about a 10% increase in the month of December listings taken. I think you're actually looking at the new system there.
Yeah. Yep. Well, if we talk, we're comparing it to number of new listings comparatively to December of 24 or year over year. I mean, if we go statewide, we actually have 50% more active inventory of new listings. So not just total inventory, but 50% new listings. But if we go, here's what's really wild. So 50% new listings, but because of increase in days on market, our total active inventory is zeroed out. So if you take our January, compare it to 24 of active listings, they're almost identical. Follow me here? Is this confusing?
I think you confused me.
That's okay. That's okay. So new listings, we have a lot more new listings coming on than we did in December.
But define a lot for me.
So, I mean, just to throw this out there. So when we compare January of 24 and we look at January of 25, and we compare it to December of 24. So in that 1 month, we saw about 50% more new listings that waited for the reasons you already said.
But that's
elections.
normal for those months, isn't
Absolutely.
it?
We get past the holidays. So that part's normal, except for the fact that
the amount of competition that's out there.
The amount of competition is held strong. And that's where I was going with that piece of it is we have a lot more inventory than what we've seen year over year. But when we go month over month, there's not that much more. So take us into February. Once we see February numbers, I think that's actually going to get even higher, where we're going to have significantly more active inventory in the state of Iowa than we previously had.
Yeah, I guess I'm not 100% sure I track
following me here. Yeah.
Well, mostly just because the rate of sale will increase as we come into February and March as well. So is that increase in inventory or listings, is that relevant just because we're going from December to January? So we typically see that spike. The inventory levels, because I was just like, I've got DMAR and a few of them in front of me, aren't notably higher, right? Like there was about 2,000. Again, I'm just looking at DMAR's resale numbers. 3,500 overall listings, DMAR, still 3,500 a month later.
Which makes up half the state in the Des Moines metro of all active listings.
I imagine that's true statewide.
Yep.
Well,
and so I like looking at DMAR as kind of an example of the entire state, except it's been very interesting as we started dissecting that, is that things in the metro area have actually been better than what we've seen in some of our other large cities. And we can get into that in a little bit here when we talk sales.
Okay, so, and I want to try to just put some flags in the ground.
Yep.
We have seasonally, obviously, we've got a pickup in listings showing up in January.
Which is normal.
Overall, what we're seeing is year over year about a 27% increase in inventory, and that I think holds true. I think that holds true in the state numbers as well.
Almost identical.
And what that's fundamentally resulting in is more competition, and I think that's what's leading to the fact that right now, well, no, I'm sorry, I was going to say that that's what's leading to a 40% rate of price reduction. 40% of listings currently are taking price reductions, but that's not just about inventory. That's a function of inventory and sales.
A slowdown in sales is going to do that.
Okay, so I think this is going to be something to watch, and I think this is going to be my point on every single one of these. We've seen this increase. We're trending towards pre-pandemic levels, but there's some forces at play right now that might slow the rate of new listings. Some sellers might go, wait, I'm not sure I'm going to get the price that I was hoping for. I may hold back. I have no projection for where that goes this spring, because it seems like interest rates not dropping, which is, I think, our next topic, might disincentivize some of those sellers. I guess give me your, and it's dangerous always to make projections, so I'm not going to put you on the spot, but what's your sentiment on that? Do you think that inventory is, in fact, going to increase by that 15% throughout the course of the year or not, and why? Are we going to see inventory keep going up?
I do think we see inventory keep going up, but I think part of the reason for that inventory, 10 to 15% increase throughout the years, that's a lot of additional inventory that we're carrying.
But it's not 27 from last year.
I was just going to say, but it's not where we were last year. I think that the big piece of this, I'm intrigued to see, do sellers accept the fact that their prices of their homes are not artificially inflated, right? We had this accelerated appreciation. Do sellers accept that faster than buyers accepted that interest rates are going to stay high?
And that's the marketplace I'm talking about.
And that's the marketplace, because like we talked about, we knew in 2023, buyers were shocked by 8% interest rates, and we saw a slowdown. And we said, but you know what, hold tight, date the rate, things are going to get better. And they did. And we got into 7s and we got into 6s, but it took 3 years for buyers to say, oh, you know what? I'm okay at a 6, 6.5. I'm going to deal with it, because we know that if we rewind to a year ago and we looked at some surveys, about a third of buyers said, I don't want to buy right now because the interest rate's bothering me. The other it was probably another 60, I think, percent said that I can't afford because the prices of properties have skyrocketed. And so I think now more buyers are going to ignore that piece. Those third of buyers that interest rates were keeping them out, I don't think that's the piece anymore.
Well, they're still feeling it.
They're still feeling it, but there's nothing they can do
about it at this point.
And I think they've realized that waiting isn't getting them anywhere, because we're still seeing appreciation of around 3%. So it doesn't mean that homes are getting cheaper. It just means they're not getting expensive as quickly.
Okay, so let's leave that flag in the ground. We're going to see where inventory goes.
Yep.
The good news is whatever increase that we're going to see, it's going to be slightly muted compared to last year. Not good news, but we're nearing I wouldn't call it a finish line. I don't think inventory is going to end up above pre-pandemic levels, but we're inching back towards.
Yeah. What I don't want to see is sellers that stay out of the race, that stay out of the marketplace because they're hoping that their property goes up another 10 to 15% in value over 24 months. I don't want to see sellers waiting on that because I don't think that happens either. And so it's the realistic side of the sellers hopefully is internalized faster than maybe what buyers did with interest rates.
Kind of the standoff between sellers and buyers. Do sellers just deal with it?
I think sellers have to deal with it, and I wonder if they deal with it faster than buyers.
I think they deal with it faster when they find something that they want to buy. So that's where the interesting inventory chicken egg problem comes in. So let's jump to rates. It sounds like you've got a lot on that. Maybe you've been watching that real closely. At the national level, here's the narrative as I would understand it. For quite some time now, we've been holding the line just under 7%. We had one or two Fed funds rate reductions mid to late last year, and that really had no notable, not even like it was moot, right? There was no change to the 30-year as a function of those. And so we're still sitting at just below 7. And as of the last even 2 weeks, the announcements that have come out from the Fed really indicate that there's probably very little likelihood of any more reductions here in the next 6 to 8 months.
Yeah.
And so what we can expect at this point, and I think you alluded to the fact that they may even go up, but at the very least, we can expect that rates aren't going to notably go down.
Right.
And so that means we're sitting at the projections that we have here. Let me see. The average for the end of 2025 is a 6.5% rate, but even that might be lower than what we realize.
Right.
But Fannie Mae and MBA and Wells Fargo all projecting that throughout this quarter, we're still sitting at like 6.9. By the end of the second quarter, still 6.8. So no, I don't know, relief in sight there. But I'm interested to hear your thoughts on it. My thoughts on this increasingly have become, this is better. I think, as we had talked about the last time we talked months ago, a reduction in rates now would hypothetically just lead to more inflationary pressure on prices, and I think just a continuation of the problem. What this is a real look in the mirror for the market. Okay, hold on. Prices are kind of high, and the cost of money isn't super cheap. There's no incentive coming my way to give me free money or cheap money. If I want to own a home, this is the cost of home ownership, and it's a little pricey right now. Yeah. And yet the market is still responding at a relatively high rate. 4 million sales last year. We'll see what this year is. And I actually view that as a much healthier outcome. If rates had come down, that'd be wonderful for sales in the first and second quarter. But what would it do long-term for the actual health of the marketplace? So my synopsis of this is, don't expect rates to come down this year. Chris Caramonte, shout out to you. You called the negativity on this one. But I actually think that's a healthier outcome for the long term. What's your thoughts on all that?
And you and I have had this conversation plenty, and I think a lot of our agents have had this conversation with us, is we have a very similar mindset that a huge drop is going to flood the marketplace with these buyers that have mentally been waiting for this drop. And we know what that would have done is it wouldn't have created savings for buyers. It would have, again, accelerated appreciation so quickly that home prices were above what they ever should be.
And we cannot afford.
We can't do that again. We can't do that again. We'd be pushing too many, and not just first-time buyers out at that point. You're pushing move-up buyers out when we start seeing cost of borrowing plus increases in what could be our sales price. I think what gets really interesting, though, is as we're seeing this increase in inventory, and if that continues, but rates go up, what does that do with our days on market? What does that do to our prices? Like you said, 33 to 40% are seeing price drops already. I don't think that's because properties are going down in value by any means. I think it's because properties were overpriced. So do we see some self-correction, but do we see fewer sales because we have so much inventory and rates have gone up? Or do we see people that are still like, nope, this is my time because values seem to have stabilized a little bit. This is when I want to jump in, even though I'm paying a little bit more to borrow. That's where I think things get intriguing when it comes to what does this look like from a rates perspective, and how does that influence sales?
Well, the good news is that these sellers have record levels of equity in their properties, and
incredible.
The prices that they were putting out there are being, quote unquote, rejected by the market at these present rates.
Right. That's why we have so many reductions.
It sounds great.
Yeah.
It sounds like that's what we need. It sounds like either we create more affordability by re-deflating rates to unhealthy levels and incentivizing buying at prices that people actually can't afford, or we hold the line on these rates, and in time, what that's going to functionally do is push listing prices down. And when I say down, I don't mean market corrections where we see prices fall. I just think we stop seeing them increase. And that is worth talking about. I mean, we'll get the prices, but there are some larger Florida, I believe, I forget if it was Nevada but we are seeing a couple of markets, states that are seeing on average price declines now. We're certainly not seeing that. And nationally, I think the projections are still for 2 to 3% appreciation next year.
Yep, looking at 3% still.
Okay, so I wanted to jump, the final slide you actually have there in that handout I gave you, I think is worth talking about here in the context of these rates.
Yep.
So you're talking about buyer demand being slightly suppressed, I guess. Suppressed is the wrong word. Held at bay by the fact that money's not going to be cheap in the next 12 months. The interesting the counterbalance to that is this data here. This is, again, from the most recent KCM, but it's a record percentage of Americans are planning to buy a home this year. So I'll read the numbers. In 2020, 9% of the U.S. population stated that they were intending to buy a home in the next 12 months. In 21, that was 11%, 22, 11%, 23, 10%, 24, 11%. In 25, that number is now at 15%. So by a notable increase, that's a 50% increase compared to the 10% levels. When surveyed, that's I guess the way I view that number is that's the number of people being held at bay right now that are saying, yeah, I need into the market. I want into the market. I've been held back for the last 2, 3, 4 years now. So there's a significant amount of demand wanting to transact. Yeah. We've already discussed that there's slightly more inventory, or quite a bit more inventory available. And the wall, or the beaver dam, is how I always picture this, right? Because it's holding the water back. It's rising. It's rise to 15% of people wanting to transact now in 12 months. The wall or the beaver dam that's holding that at bay is interest rates at about 7%. Yeah. And so I think that that's worth noting for lots of reasons. It sucks that interest rates are slightly higher this year. I don't like that for our buyers, for the cost of ownership, but I do like it for the health of the economy at large. Right. There's a counterbalancing force that even though that's the case, I think the sheer number of people that need to at this point, I've had another kid, maybe I've had 2. Right. I've outgrown my house. It's time for me, even though I'm rate locked at 3% on my existing home, it's time for me to downsize. My kids moved out 2 years ago. I believe at some point that water just starts to flow over the dam. So I think that's maybe the breaking point that we're at right now, where we're seeing people choose to transact despite the cost. Yeah.
Well, I think that when we look at that 15%, though, it's like you said, a 50% since 2023 increase in the number of people that said, I plan to buy this year. I do think a piece of that is the acceptance of rates. Yes. I think they've looked at this and said, hey, I plan to buy this year because I can't control these, and hey, it's lasted long enough that I'm no longer hopeful we're going to see 3%. We've been telling them for a long time, you're not going to see 3 or 4s anytime soon.
Well, have we?
Well, I mean, I think we have done a good job of
3s or 4s, but even the hope of 5s.
Right, they've been wanting a 5.9, right?
And that's still enough to keep people saying, well, I'll just wait, I'll wait. I love that you keep bringing up the word acceptance. I think you're 100% correct. But
I think you're right that this is the point where we've got such demand that rates are a small piece of that, but not as big of a piece as they might have been 2 years ago. And so 2 years ago, when that 10%, I think we can look at that, the lowest that we've seen in 5 years, and that 10% was, I'll buy, but even I don't really want to, but I just have to. Here you've got 15% that are saying, I'm going to buy because I'm going to deal with it.
Well, and this is the ones that said that they want to. Who knows how many of them actually choose to? And I suppose that's our next topic. Not to get into politics again, because we were talking politics before we hit record. But this feels like it matches up with the general sort of tendency of where America is at right now. There's a little bit of a, we've got to grow up. I don't care if you're left or right or in the middle. We've got to grow up and realize that we can't keep having everything for free and cheap. And so this is a perfect example of that. Yes, even a lot of realtors out there right now are whinging and whining about the fact that we want the rates to come down. And Trump's out there saying, yeah, we really need the rates to come back down. And I don't care where you sit on this whole thing. The rates coming back down isn't the solution.
Right, not at all.
I get that we want affordability for people, but the smart and prudent way to get affordability is to create checks and balances, to not give free money out to reinflate the prices.
Well, and it's, like I said, I was having a conversation with my wife about this just the other day on kind of projections of rates. And we were looking at that historically where it's been. And we're in a historical average right now where we're at. You look at those anomalies that we had for that 3-year period where we were upper threes, mid threes, low threes. And then you see what happened because of that. The acceleration of appreciation, and equity is great, except when you need to use that equity to buy another home that's also appreciated so quickly. They're like, well, my equity actually means nothing because it hasn't kept up with the cost of all of these other properties. And now not only do I have to buy something that's exceptionally more expensive, my interest rate's also higher. And so while it seemed great to be a homeowner during all this acceleration, if I need to go buy something else now, I'm struggling. I think what's interesting is when you bring up that I'm intrigued by the number of people that have stayed in their homes at a low interest rate that are now looking at this and saying, hey, I don't need a house. I'll go into a condo. I'll go into a townhome because I don't need the space anymore because we stayed here longer than we planned. I think there's going to be a demographic that's going to make that data.
And it won't be a flood, but it'll
make
be
a difference.
A trickle. And at some point, the water starts to flow over that dam. I'm just really hopeful, I guess is what I'm trying to say. I like the slower version of this. And I think my messaging to our team specifically is join the acceptance.
Yeah.
I think anyone out there whining about the fact that we need rates to come back down is maybe missing the bigger picture. We need some balance and we need some health. And we need to make things, it sucks that it's still unaffordable for people, but the longer term solution to that must be to hold prices accountable over time.
Yeah. A 3% interest rate is not going to increase affordability.
Well, we did it once and it kind of screwed things up.
Sure did.
It? So like you said, 6% seems, and I want to make one more point on that as a foreigner, 6%, really closer to 7 in any other nation in the world is a dream.
Yeah.
The only reason that we can get 6 to 7% rates is because it's federally funded and subsidized.
Subsidized there.
If it wasn't for Fannie Mae and Freddie Mac and all the other institutions putting this together, no other country has 30-year loans at 6 or 7%. It's just not a thing. This is something we've created because we as a country believe correctly, I think, in the dream of home ownership. And we've created a system, an infrastructure where banks would never give away 6 to 7% loans in this environment unless they were able to sell them to Fannie Mae. And so, I just think perspective is part of what we need right now. I think our buyers are starting to understand that. And I think we as agents need to do a good job of, we can't scold people. We can't tell them, hey, but we need to help them come to terms with the reality of the marketplace. Yeah. And then maybe they need to go negotiate on some of these deals to try and help sellers who aren't yet at the point that they realize, hold on, I need to be more realistic. We need to recognize that there is the capacity to negotiate on some of these properties, and slowly but surely sellers will start to price their properties appropriately.
Right.
It seems like a healthy balancing of the market. Not without pain though, huh? Okay, so sales. You touched on this earlier. Last year, and there's different versions of this data. What I'm looking at here from KCM again was a 2020. By the way, what was the final number of sales? Because I thought it was just over 4 million. This is actually reporting 4.6.
I thought we pushed over the 4-5 mark by the end of December.
I think maybe one is single family and one is including.
And one is, I was to say, I think it's all residential. I think pushed over 4-5.
So the all residential, that would be what we're looking at here.
Yep.
If we have historical perspective, in 2021, we were all the way up to 6.9 million sales US. 2022 dropped down to 5.7, then 23 down to 4.8, and last year was only 4.6.
Right. And they were projecting last year to 4.9 when if you rewind to...
They were projecting 5.5
the beginning of the year. I think if you go back to probably early May of last year, NAR, couple others were all projecting that we'd end somewhere around that 4.9. Redfin,
they were expecting rate drops in September that were going to massively.
Yeah, June, September, they both thought were actually going to influence our
now, in
our
their
borrowing
defense, we did see November and December. They were stronger, to my recollection, than traditionally, and so we did end the year on a high, but nowhere near the high that we thought. No. And I think that's really, really easy to explain. Rates didn't go down the way they thought they would.
Yep.
So long story short, 24 was not a record year by any measurement. It's actually the lowest that we've seen in I think it was decades. And so if you're an agent and you sold a decent amount of homes last year, you actually did a great job in a tough environment.
Right.
What is being projected right now? I'm really, really interested to see your smirk or agreement or your thoughts on this.
Yeah.
So presently the projection is 5.1 million sales. What does that represent? 4.6 up to 5. It's a half increase. It's like a 10.
Half a million. Yeah.
So do you think that we see that? Why or why not? This is being recorded.
Oh, I know it is. I know it is.
I think there's plenty of room for forgiveness here. Like no one.
Right. The crystal ball, I think in other years, I've been a little more confident. I'm intrigued because
that's a good way to put it.
The first 6 weeks have started off strong.
For who though?
For Iowa. So I would say in the state of Iowa, specific markets, and this is where I think maybe we'll get into it later, maybe not, but we can talk about it now.
Now's the time.
You look at metro areas, and you mentioned it a little bit, but we've got a new stats program through Iowa Realtors, and it's a lot of fun because you can pick county by county, and then you can actually kind of filter out through cities. Our metro counties are strong and looking really good. The problem with MLS data is that most of our MLS data starts encompassing more rural areas, right? So Northeast Iowa is a great example. If you look at Waterloo, Cedar Falls, and Blackhawk County, looks pretty strong. If you start to expand that and you include the other 12 counties that make up that MLS, the MLS data doesn't look strong. Waterloo, Cedar Falls, you're in a strong market. Davenport's kind of the exact same way right now. Cedar Rapids is stable. They're not having a great start to the year. Drop down to Iowa City. Johnson County looks pretty good. So I think there's some anomalies here, but I think more or less we're seeing that metro areas are having a great start. You expand the data to include some of those non-metro, and it's not as great in our rural areas right now.
And I want to, great. These words, great. We had a great January as a company. Like when I say great, we were up 56%, right?
Mm-hmm.
That is not what we're seeing statewide right now. And I think I'm putting that flag in the ground because of something I want to say at the end of this podcast regarding how to engage in any market.
Right.
But we're not seeing an exceptional rate of sale that's indicating that we're going to see a notable increase this year compared to, or you're saying you think we are. It's just that we're seeing a little bit of a bifurcation. We're seeing the increase in metro markets. Iowa is largely rural, and so some of the rural markets tend to bring that mute that number down. And you think that'll hold the line throughout the course of the year, or that's just a seasonal thing?
No, I think the water is starting to simmer, and I think that when we see year over year from 24 to 25, our January was 5% up in sales. Doesn't seem significant, but Iowa.
Okay,
Iowa was up 5% in sales. I think it doesn't seem like a significant number, 5%. You're like, it's a decent increase, but nothing substantial. But I also think there's a lot more momentum that's building behind that, which is interesting because nationwide, if you listen to Altos, you listen to KCM, they're not feeling that. They're the exact opposite direction. They've become a little more
skittish.
They're very conservative on their projections. I think if we showed them now, this week, this 5.1 million projected
they may look
sales,
at that differently,
they're going to say bring that down. I'm looking at it and saying, I think because of again, it doesn't feel affordable, but Iowa is affordable. I think we're seeing that people are combining those interest rates with the buyer demand. And I think the first 6 weeks, but the first 4 weeks, 5% over. I think when we see the end of February, we're going to see an even bigger increase. I think that continues on and actually gains momentum for Iowa. I can't speak to the rest of the country. I'm not as confident there. I don't think it's going to be a nationwide trend that we hit that 5-1, but I think Iowa comes out ahead.
Well, I think we will see. And I think anyone speculating at this point is, even though I asked you to, I think we're all in no man's land on trying to figure this out. So, and there are some forces at play, like all this trade war stuff going on may expedite. I mean, we're seeing a lot of layoffs. Everyone is laying people off. And so the reason the Fed's holding the line on interest rates is because there's still some inflationary pressure. And yet we're about to see a whole lot of negative data show up. And we're going to see negative data on sales, on price reductions, on average list price. All of that's going to start showing up in the news cycle. And so maybe 3 months from now, who the heck knows if we end up with another 25 or 50 basis point reduction. I think it's up in the air.
Well, and you know, we mentioned this. You and I probably talked about this at the beginning, that if we would have recorded this 3 or 4 days ago, and I had looked at projections where it said that by the end of 25, we'd be closer to a 6, and then we will be under 6 by the end of 26.
That seemed reasonable.
Seemed reasonable. You know, most recent data that just literally came out yesterday tells us that the CPI increased by 0.5%. Inflation now is at 3%, which was not expected, which is our highest level since August of 23. And we know that 4/10 of that increase is housing, is shelter. And so that starts to concern me a little bit, that the momentum might be slowed just a little, because, if you said, there's tariffs, there's different I think views on trade right now. So I think the Fed is saying, hey, like, I know you want us to bring these rates down. We're not seeing any data that tells us we should. And that concerns me, that the Fed might look at, you know, depending on what happens in February, March.
You said they may raise rates.
I think there could be a slight increase in rates to combat inflation. And if that happens, all of this twists.
And I'm going to say I think that's highly unlikely.
I'm hoping.
I'm going to asterisk that with who the heck am I to say that.
And who knows right now?
Okay, final topic. We've covered inventory, rates, sales, pardon me, price. I think we already touched on the data here. As of a few weeks ago, most recent projections were for an average of about 3% appreciation. You got some projecting as high as 5%, some projecting -2%. That was Morgan Stanley. Yeah. The average of all of these price forecasts for 25 is about a 3% appreciation. That, well, first of all, historically is a very muted but average. That's normal. 3 to 4% is what we typically see. I think that would be spectacular, and that's exactly what I would hope for the year. I think we locally need to get real specific on that. I think that there are some areas of the market that may actually see a slight pullback back on average sale price. Others where we will see continued appreciation higher than that. Thoughts on pricing and maybe where this matters for our team?
If inventory continues to increase as it is, we've got a pretty substantial amount of active existing inventory right now. So if we keep new listings at the rate that they're coming right now, and it doesn't really matter in which marketplace, we're seeing additional inventory coming. If that, and we talked about this earlier, if that doesn't slow down, we're going to have to see either substantial increased days on market, or we're going to have to see even more price reductions, and maybe both. But I think that pricing right now, and it's that elevator speech to our sellers, it matters because this market isn't the 21 and 22 market. We are in a new place where buyers have some options. And we've seen this over the course of the last 12 months when we start looking at cancellations. And we've talked about this, is buyers are asking for more in inspections, and buyers are walking away a lot more often. And buyers are gaining a little bit of that power back that they didn't have any during those hottest times in 22. Right? They're waiving appraisals, they're waiving inspections, they're taking risks because it was their only opportunity to get into home ownership.
Which, by any indication, by any
it's not healthy.
No, you know that's an unhealthy.
Yeah, we didn't. We knew it was what you had to do. If you had a buyer that said, I absolutely have to buy a home, these are things you're going to have to consider.
Ironically, when they did that, in hindsight, they probably don't regret it right now.
No,
they're glad.
No, they're happy because they're happy they got in. But I think that the inspection piece we saw in 2024, just for example, of buyers starting to gain a little bit of that back. I think that continues now because of inventory increases. And so there's going to be more negotiating power. And year over year, or month over month, we're seeing that properties in we're selling about 96.5% to sale price to list price. It wasn't that long ago that we were sitting in our meetings saying that properties right now on average are selling at 101% of price. So this tells us that it's correcting itself. I just think that what we're also seeing is that the expectations of sellers have started to calm down a little bit, and they're realizing that, you know what, we shot high, market is not responding, we're going to have to come down, and we're seeing it in a lot of our local markets. You follow the MLS, the number of price reductions we're even seeing in our local places. I don't know that it's coinciding with national data, but we're seeing 40%, but we're seeing a lot of price drops.
We should look at that.
It'd be interesting.
I haven't taken a look at that closely. And maybe that would be thrown off by, if we're doing a great job of great consultative conversations with sellers up front,
we shouldn't need them as
see
much.
Fewer. Yeah. I think that 40% is representative of agents doing a poor job of upfront guiding and counseling. But I think I see that the media is going to put that out as negative news. Yep. That's going to be a negative news cycle. Oh my gosh, 40% of people have to drop their prices. Yeah. I look at that and it's a slow clap from the sidelines. Yeah. I think it's wonderful. Not that people are losing value or losing money on their homes. They're not.
No,
not
at all.
Just having to come to terms with the reality that what they thought they were going to get, they're not, and they need to get more realistic.
Well, and again, seeing this data is probably impossible, but to know, we know there's agents that will list at whatever price they have to list to get listings, right? That's a real thing. And it'd be interesting to see some type of correlation between how many of those agents are listing high, dropping, and then another agent is getting that listing and eventually selling it. Because I think what we're probably seeing is we still have an abundance of agents. We have way too many licensees and pick anywhere. I think that's influencing some of these pricings as well, because they don't know how to price in a market where it's competitive.
Okay, that's not on our agenda today.
That's not,
I'm going to ask the question.
Gosh.
So 1.5 million realtors somewhere around the end of 2024. Because if I'm talking to realtors right now, our team, our agents, prices matter, but that's more in the context of how we consult effectively, how we consult with our sellers. Yeah. If you have a big portfolio of real estate, it might matter to how your equity position looks. But prices, I don't think, is the most central thing. I think what matters to our agents is, are sellers ready to come to market in order to provide a supply for the number of people who want to buy. And then rates really, really matters, because that is the wall between the two spaces, right?
Fair.
But the other part that matters is the number of real estate agents out there that you're competing with. So if we closed out with 1.5 million, an all-time high, I think 1.6 was the highest. What are your projections for rate of attrition? What is IAR and what is NAR saying about rate of attrition for real estate agents?
Well, and so end of 20, probably not the end, but third quarter of 23, they said to project for by the end of 24 to see about a 20% decrease in total membership.
By the end of 24.
So that was, they assumed, because 23 was so rough on agents, that they were either going to be done by the end of, so this was in total from the Q3 of 23. So give it 2 more quarters, and then by the end of 2024, we should see almost a 20% drop. We didn't. We held steady. I mean, even in Iowa, it fit the normal curve of, we always lose a few agents end of year, and then we add new agents after the beginning of the year because they're waiting to get licensed. So where we thought we would see a 20% decrease based on what was assumed, NAR lost some members, but not many. IAR is held pretty steady. So we're still over 8,000 members in the state of Iowa that are practicing real estate.
And this is even in the context of all the drama.
Down years and buyer's agency and people realizing real estate's not as easy as it looks like on TV or social media. So we're oversaturated, and especially with agents that aren't well-trained and don't know what they're doing. And somebody just said to me this morning, I spend a lot of time training agents from other brokerages on how to do business right because they don't know what they're doing.
So do you think that we'll see that 20% in 25?
No, I think it has to be a much more difficult marketplace, because we're still seeing, you
need real pain. This is
it needs to really hurt. Yeah. And it's not yet. And again, I mean, we've got agents in our walls like, 2023 was tough. 24 was tough. And it was, but we still look across the board and it's not where we saw our big dips in membership when things were really hard.
I guess let's see how the year pans out. My case to be made for that we will see increased attrition would be that despite the fact that the market's not that bad and 5 million, 4.6 million, it's all doable. There's at the same time the Pareto principle 80-20 has moved to a 90-10, and
sure has.
Most of that business really was conducted by a handful of agents.
I'm hoping. I mean, I'm hoping that's what happens.
There is a starving that is happening at the bottom,
for sure,
and it's just a matter of time before paying the fees is just not worth it. I mean, a lot of people have gym memberships that don't go. It takes a couple years for them to go, oh, hold on, and then the credit card expires, and then they stop paying. Maybe that's what we'll see.
I think it'll be interesting, and I'm hoping. There's some stats that came out probably mid-January that caused a bit of an uproar. That about half of realtors across the country didn't do a transaction in 2024. But it's an anomaly.
Did you look into that data though?
Well,
that was Jared James.
And so here's the deal: is they're including, association staff, because those are realtor members. Okay. They're counting you and I, who I didn't do a transaction in 2024. And so you start taking some of those numbers away of people that are staff.
Yeah, but still.
It seems negligible, but it's actually...
Yeah, but if you had 71% of agents was what I saw quoted, 71 and I saw 74, sold 0 homes in 2024.
So it was closer to half. But
even at 50%, that's what I was going to say. If that number is completely inflated by 20% or whatever.
It's closer to 50, yeah.
So 50% of agents sold 0.
Yeah, 750,000-ish.
Yeah. I look forward to, and the problem is the job market's not great. And But yeah, I'm going to continue to watch that space. You know what we're committed to, and that's raising the bar. And I cannot believe that if you're not, frankly, 0, forget 0, 1, 2, or 3 sales a year, I still think that you are not a trusted advisor and a professional. Okay, final thoughts here. I just want to talk about the game plan.
Yeah.
Try to help me get practical for our team.
I like it.
2025, I'll just share with you a few thoughts that I wrote down, and then you give me yours. Practically what I think we need to be focused on, given the market conditions. One, I think we really have to put on our consultant hats coming into this year. We have to be trusted advisors and not salespeople. And a good example of that is now's a great time to buy, now's a great time to sell. I think that's been heard.
Yeah.
I think what we should rather be engaging in is, here's what you need to consider if you're thinking about buying or selling. And we have to start providing consultative insights to people, because it's not what it used to be. It's not just a function of how quick can you get the best rate so we can go make multiple offers. It really is. This is a dynamic and shifting environment. How you position up front on the listing side, how we negotiate on the buy side, there's a lot to consider. Second thing I wrote down was I think we have to get hyper localized with our market data. I know we've been doing training again on market absorption analysis. Some of our team were shocked at how few of our agents actively use market absorption. And I don't just mean that like, there's 4 months supply. I mean, at the hyper local level, running an absorption analysis for your seller and for your buyers, frankly, to understand the very local specifics of what's going on.
And being able to explain what the implications of that is. Because running the analysis is fine, but if you can't explain what that means, we have to be able to explain, this is what this means for your home in this price point in this neighborhood.
Third thing I wrote down, all of this conversation, and I've been thinking about all of this for quite some time. I'm encouraged and I'm hopeful for a slower, muted, but more balanced and maybe responsible recovery is how I would think about this. We've had markets go up and down. We've had incentivization from the year 2000. We've had tax credits. We've had deflated rates. We've had so much crap that's led to where we've been. 2 years back to back of 20% appreciation is a symptom of stupid decision making. Yeah. And I know there's some pain. I know we want the interest rates to come down. I know affordability is bad, but I'd really like to see inventory keep inching up. I'd like to frankly see rates hold steady. I don't want to see them go up, but I love the idea that where we find ourselves at the end of 25, coming into 26 and 27, is that balanced market that we've always talked about. 5 to 6 months supply, healthy amount of inventory, and a little more affordability, but it costs some money to buy a home. Two more things real quick. I do believe there's a negative news cycle that's on the way. I think if you look at November, December, there was a lot of good news about real estate sales.
Right.
But the rates that we've talked about, the inventory levels, the price reductions, I do think that the market's going to have a lot of that in the next 2 to 3 weeks as this information gets out. And I do think we need to be prepared to engage with our sellers about that information. Final thing I want to say, and then it's to you to take us home. I always think when we talk about the market that there's a danger for our agents to, is the tide going up? Is the tide going down? Is the wind at our backs? Is the wind in front of us? And I mean, it's important to know. And it's important to know so that we can actively and proactively consult with our clients and make smart decisions. I also want to say that we sold 56% more houses than we did a year ago in January, while the marketplace was about 5% up. And I think every single one of you have the capacity to take control of the things that matter inside of your individual spaces. You can go and have more conversations. You can go and be a better consultant. And so the market's going to do what it's going to do, and a rising tide raises all boats. I don't think the tide's going to rise that much next year. And to some extent, this year, I'm grateful for that. 5 million sales sounds perfect. Go and make sure that you get a disproportionate portion of that market share opportunity. It's a phenomenal time to be really good at this business. And I think everyone needs to make sure that they're really good at what they do, because I think there's plenty of opportunity. And the reason I'm excited about that is the work that's being done now to gain market share in a still somewhat tight environment, I think is going to produce massive implications for the right people over the next 3 to 5 to 7 years.
Oh, yeah.
So that's my thoughts. What are yours?
I like it. I've got lots of thoughts. I think that, just to reiterate, and I think this is a bigger deal than maybe you even just made it right there, the fact that we're up 56% year over year for our sales in January, and the rest of the state of Iowa is up 5%, is a bigger deal than maybe people are realizing. Now, does that trend continue through all of 2025? Probably not, but it does tell us that what we've been doing over the course of the last 12 months has been the right path. And so I'm very, Whitney would call it my C21 childlike wonder. I'm very proud of what we do here, because we do it differently. And I encounter enough agents, and now in the position I'm at, enough brokers that call me confused and honestly just ill-prepared. And I think to myself, well, not only are you as a broker not ready for what you weren't ready, and you're not ready, but that means all of your agents aren't either. And the more time we spend knowing that we are doing the right things and learning the right activities and talking to our people about what is going on is only going to make it better. Not just in 3, 5, 7 years. I think we see it better in 12 months. I think the end of the year looks better. I think the other big piece of this is we keep hearing over and over and over again through all of the research, all of the surveys, that clients want our help. And it's not just that they want somebody that they can get them into properties and write offers or list houses. They want someone that knows what they're talking about. And like you said, that expert advisor, but that actually provides insight and helps them through the process. And I think that's where we set ourselves apart from some other brokerages, that their goal is purely transactional. We're creating relationships to build advocates, and we're in a good spot to build business because people are going to trust us. And that trust is bigger than anything else we're doing right now.
Yeah, it's good stuff. I'm excited for what the year looks like. And obviously, if you guys have more thoughts or questions on the market, excited to chat about this briefly at our team meetings maybe next week. But it's exciting. It's an exciting time to be in real estate. The world's crazy right now, and there's all sorts of forces at play. But as always, take control of the parts that you can control and go make a great outcome. But thanks for all your insight
Absolutely.
today.
It's great.
I think I've got a funny feeling that throughout the course of this year, we're going to be talking
Might
about
have a
the
few
market
more
a
of
bit
these.
More, yeah. Okay. Have a good day. Joining us today. For more episodes, resources, and show notes, head to morethanmorepodcast.com.